Good afternoon. Today, we are going to look at assignment 2 of 2022. Then from there, we finish the last part of practice questions 3, because for practice question 3, there is question 4 that we are still to do and attempt as well. Then after that, it should actually take us the class. Then after this, I'm going to share more practice questions. By tomorrow morning. You should be having another set of practice questions as well. Because remember, from the information that I got or that I gathered from the students' feedback, the lecturer said that concentrate on the current year's assignments and also the information that is in the new textbook as well. So if that is going to be the case, it means that once we're done with the assignment, then we can continue with the practice questions as well. Has there been any other communication from the lecturer over and above this? Or has the lecturer shared any practice questions over any other questions that he said that we are relevant when it comes to the exam? Has the lecturer shared any practice questions? Okay. Okay, I assume not. All right. So what we're going to do is that once we finish the assignment questions, we'll go to and finish the last set of practice, the last question of practice questions 3. Then by tomorrow morning, I would have shared another set of practice questions that we can also use to prepare for the exam as well. All right, so looking at assignment 2, for assignment 2, question number A, or part A of the question, they give us that information. And from the given information, they give us information about the return objectives, and also they give us information about the tracking error for this portfolio. And based on this, they give us the allocations, the expected active risk, and also expected active returns, and the fees that are going to be relevant for these particular portfolios as well. Then they say the returns are net of any trading expenses and the gross of the fees, which means that we would not have taken into account the fees as yet. So for part A of the question, they say, calculate the information ratio of the core satellite portfolio and show your calculations. So for the core satellite portfolio, they are telling us that for this core satellite portfolio, they are telling us that for the 100% of the core satellite portfolio, it's made up of an enhanced index, investments in the enhanced index. Then there's also active portfolio, which is going to be active A and active B as well. So with the core satellite portfolio structure, they're basically saying that for a portfolio that is a core satellite structure, it basically means that that particular portfolio has a core investment. So there is a core investment. So for part A, there is a core investment. And then there's also going to be satellite investments. And as you can see, the satellite investments in this case, the satellite investments are investment A and investment B. So investment A and investment B are the satellite investments. And the core investment in this case is the enhanced index. So this is where the core satellite type of investment style comes in, where with the core satellite structure of the portfolio, it would mean we have a core portfolio and satellite portfolios. And with satellite portfolios, this is where our investment strategy is going to be slightly different. So that's why you see that for the core portfolio, the allocation is 50%. And then for the satellite portfolios, there's 30% in A, and then 20% in B. So that's basically how the core satellite structure in this case is structured. So for part A of the question, so looking at part A of the question, remember for part A of the question, part one, they are asking us to calculate the information ratio. So in this case, they are asking us to calculate the information ratio of the core satellite portfolio, right? So to determine the information ratio of this portfolio, we see that the information ratio is given as the expected active return divided by the active. So it's basically your active return divided by your active risk, not expected. So it's your active return divided by your active risk. Now, on the given information, if you check on the given information, okay, it's your X, basically the expected. So it's your expected active return divided by your expected active risk. So if you check on the information, remember on the question, on the information or on the question, they had given us that information where for the core satellite portfolio, they say that for the core satellite portfolio, the expected active risk is 1.92%, and the expected active return is 2.95%. And they tell us that the fees in this case is 0.38%. So which means in this case, for the core satellite portfolio, it means if we do the calculation gross of the fees, before we take into account the fees, so gross of fees information ratio is given as, now remember we said that our expected active return is given as 2.95%. So as a decimal, it will be 0.0295 divided by the expected active risk as a decimal is 1.92%. So as a decimal, it's 0.0192. So in this case, how much is going to be the information ratio before we take into account the fees? How much do we get?
$1.54.
So we get a figure of 1.54. Then the net of fees information ratio would be, so from the, remember they tell us that the fees is 0.38%, isn't it? So from the active return there, from the expected active return of 0.0295, we're going to be subtracting the fees, which is 0.38%. So as the decimal, it's 0.0038, and divided by your expected active risk of 0.0192. So in this case, how much is going to be the information ratio net of the fees? So how much would be the information ratio net of the fees?
$1.34.
We get a figure of 1.34. So what the information ratio means, you are saying how much is your active return compared to your active risk. So how much is your active return per unit of active risk? So this 1.54, in a way, it's just the same as saying 1.54 over 1, because for 1 unit of risk that you're exposed to, you are generating 1.54 units of active return. That's basically what it means, before you take into account the fees. Then net of fees, this is the same as saying 1.34 over 1, because for 1 unit of active risk you are exposing yourself to, you are generating 1.34 units of what? Active return. That's what it means. That's what the information ratio basically tries to interpret. Are we on the same page? Any questions? Right. The next part of the question, they say, determine whether Mabu's recommended core satellite portfolio is appropriate for UNISA, and justify your response with 2 reasons specific to UNISA. Now, when we look at the investment policy statement, they say the return objective for equities is to earn 2.95% above the return on the broad market index relative to the benchmark. And the tracking error should not exceed 1.5%. So the tracking error should not exceed 1.5%. And at the same time, the return objective is that your equity should earn 2.95% above the return on the broad market index, which means that the broad market index is basically, in this case, is your benchmark return. So you should be earning an active return of 2.95% above your benchmark. So you should be earning an active return of 2.95% above the benchmark. So if you check on the information that we're given, what do we see? So does it mean this portfolio is appropriate for this particular portfolio, that for given those minimum recommendations that, or those minimum requirements that are going to be put forth for our portfolio in this case? So what do we see? Now we need to find out exactly, so how much is our expected active fee and how much is our expected active return for the portfolio. So if you check all the information that we're given, we see that, remember, our portfolio, the core satellite portfolio, remember we say that it has an expected active return of 2.95%. So it has an expected active return of 2.95%, but there's also a fee of 0.38%. So what does that mean? It basically means that our expected active return net of fees is equal to 2.95 minus 0.38. So how much is our expected active return net of fees for the core satellite portfolio? How much is it going to be? How much is it? How much is it? How much do you get?
2.57.
So we get 2.57%, right? Remember, the requirements for our objective was to earn 2.95%. That was the return objective, isn't it? So net of fees, our core satellite portfolio is failing to meet that objective. Also, if we look at our expected active risk, our expected active risk of the portfolio is equal to 1.92%. So our expected active risk of the portfolio is equal to 1.92%. But remember, they say the tracking error should not exceed 1.5%. Our tracking error, which is the expected active risk, is 1.92%. It's greater than the 1.5% that has been set for. So in this case, our core satellite portfolio is not appropriate. So the core satellite portfolio in this case is not appropriate because it's failing to beat the benchmark net of fees. And at the same time, it is an active, it is a tracking error which is higher than the tracking error set forth by the organization, which means that it's got higher risk than the risk the organization is prepared to pay to check. So it's got a higher risk exposure than the organization is prepared to check, because the tracking error of 1.92% is greater than the maximum allowable tracking error of 1.5%. Are we on the same page? Any questions?
Oh, there is a word called satellite approach there. May you please explain it?
Remember, I said core satellite portfolio. I did explain it at the beginning of the question there, where I say if you have a core satellite portfolio, it means your total investment is a core investment. Then there are also other smaller investments that are also going hand in hand with that core investment. As you can see, our core investment here is the enhanced index as a portfolio where we're invested 50% of our total investment. So our core investment here is the enhanced index portfolio, because it's got an allocation of 50%. Then the satellite portfolios are those active investments A and active investment B, where for active investment A, we invested 30% of our portfolio, and active investment B, we invested 20% of our portfolio. So with the core satellite portfolio, we are looking to part of our portfolio. We are saying we're concentrating on ensuring that we're not too exposed to risk. As you can see, we're investing in a particular enhanced indexing strategy. Then these ones are the ones that are prepared to take more risk on, the active investment portfolios. So that's basically where the core satellite portfolio basically comes in.
Thank you, sir. Thank you.
All right. Are there any other questions? All right, so can we move on to the next question? So on the next question, which is part 3 of question A, they say, alternative investments are also part of UNISA retirement plan portfolio, and Mabwe has a strategy of rolling forward a long position in platinum futures traded on the JSE. So Mabwe's expectations are as follows. Electricity supply disruptions in South Africa, the world's most dominant platinum producer, will cause platinum supply to fall and spot prices to rise. And at the same time, the interest rates will fall and the convenience yield on the platinum will decrease. So Mabwe observes that his expectations are not yet reflected in platinum futures prices. And from there, they say, Mabwe reviewed the recent performance of the platinum futures and has found that for the last 12 months, the platinum futures had a raw return of negative 6.4%, a spot return of 10.2%, and the collateral return on the platinum futures over the past 12 months was 7.1%. So for part 3 of the question, they say, determine, given Mabwe's market expectations, given that Mabwe's market expectations are correct, whether an increase or a decrease, or a no change in each of the following return components should be expected, and justify your response with one reason. And the return expectations in this case that we're analyzing is the spot return, the collateral return, and the raw return as well. So if you check on the lecturer's answer, they say, when you look at the spot return, they say this is the return related to changes in the underlying commodity, which is platinum, using the cost of carry model. So Mabwe expects that the spot price of platinum to rise, which would cause short-dated futures prices to rise as arbitrage trading occurred. So which means in this case, with the cost of carry model, we're basically saying that you're buying at a lower price and with the intention to sell at a higher price at some point in time in the future as well. So that's basically what the cost of carry model basically says. So you're buying in security which is undervalued today, so that at some point in the future, you're going to be able to sell it at a higher price in the future as well. So which means in this case, when you look at the spot return, remember the question was telling us that they're telling us that the supply to fall and spot prices to rise. So which means because he's expecting the supply to fall and spot prices to rise, it basically means that in this case, this is basically why we are saying that the spot prices are going to rise in this case, which means that you're going to be able to get what? The spot return is going to be generated in this case, mainly because you are expecting the prices in the future to rise. And if you're expecting the price in the future to rise, basically means that you're expecting to buy low now and sell high at some point in the future as well. Hence, you're expecting, this is because the supply is going to fall and the spot prices are expected to rise. So this is basically where the spot return is expected to happen in this case. So this is why we are saying that when you look at your spot return, we're expecting it to increase in that case. Are we on the same page? Next, they discuss the collateral return. And here they say, this is the return that arises from investment in platinum futures rather than physical platinum. So Mabwe is able to invest the full value of the underlying contract and earn the risk-free interest rate. So since he expects the interest to fall, the component of return will fall. So now, looking at this, remember they say, when it comes to collateral return, this is the return that arises from investment in platinum futures. So if the return arises from the investment in platinum futures, now we need to find out exactly, so what are we expecting to happen to the platinum futures given the movement in what? In interest rates. So in this case, if, remember we say your futures price is given as the spot price in brackets 1 plus R to the power of T. So this is how we're able to ascertain the futures price. So which means if your futures price, if your interest rate goes down, you are also expecting the futures price to go down. So which means now, if your futures price goes down, it basically means that your return in this case, which is your collateral return, is also expected to decline, because your futures price is expected to go down or to be negatively affected by the decrease in interest rates. Are we on the same page? Moving on. We also look at the raw return. And when you look at the raw return, remember here they say the platinum futures had a raw return which is negative 6.4%. So the raw return in this case is expected to be a negative 6%. Now, when it comes to the raw return, they say this is the return that arises from rolling long platinum futures contracts over time. So Mabwe expects the convenience yield will fall and decreasing the raw return. Also, he expects the interest rates will fall, thus increasing the raw return. Then, in the cost of carry model, these two factors have opposite effects. So conversely, if the fall in the convenience yield is more than the fall in the interest rates, the raw return will fall and vice versa. So in this case, when you look at the net effect, when you look at the raw return, you're basically looking at the net effect of exactly what is happening to the spot return and what is happening to the collateral return in this case. So here they say, since where the Mabwe expects the convenience yield to decrease, to fall, isn't it? So this is going to end up decreasing the raw return. But at the same time, he expects interest rates to fall, and this is going to have an increase, is going to end up increasing the raw return as well. So the overall effect on the raw return will depend on which one is having a bigger effect. Is it the effect of the convenience yield, or is it the effect of the interest rates as well, which is going to end up having a bigger effect in that case? So that is what's going to cause the raw return to either go up or go down as well. Are we on the same page? Moving on to the next question. For the next question, they say, calculate the total return on the platinum futures. So they're asking us to calculate the total return on the platinum futures, given we have an effect on the spot return, the collateral return, and the raw return as well. So they're asking us to calculate the total return on the platinum futures, given that there's an effect on the spot return, the collateral return, and the raw return as well. So to calculate the total return on the platinum futures, we're going to say as a formula. So as a formula, we are going to look at your total return. Your total return is given as your raw return plus your spot return plus your collateral return. So it's your raw return plus your spot return plus your collateral return. Now on the question, they told us that the raw return is negative, isn't it? So if you check on the question, they told us that the raw return is a negative 6.4, the spot return is 10.2, and the collateral return is 7.1. So given this information, it would mean we're just going to be plugging in that information. So it's minus 6.4, because it's a negative 6.4, plus your spot return, which is 10.2, plus your collateral return, which is 7.1. So given this information, how much would you get as your total return effect?
$10.9.
So your total return is 10.9%. Any questions? So overall, we are expecting that the net effect is that your return expectation is going to be 10.9%. Can you move on? On the next question, they say, discuss the potential benefits to UNISA retirement plan of adding commodities as an asset class. So the benefits of adding commodities as an asset class. So we're looking for the benefits of adding commodities as an asset class. So remember, When we look at the different asset classes, we say that you can either invest in money markets, you can invest in bonds, you can invest in real estate, you can invest in equity as well. Then the other alternative investments would be investment in commodities. When you look at investment in commodities, this is where, like, for example, you are investing, looking at investment in, for example, wheat. We are trading in wheat. You are trading any other commodities that one can also enter into as well. So when you look at the potential benefits of UNISA retirement plan to add commodities to any asset class, the first benefit that they discuss here is that commodities have shown to be effective as inflation hedges, and they offer the most benefit when there are unexpected changes in the rate of inflation. So one benefit of commodities is that they are effective inflation hedges to your portfolio. So which means they are able to generate a return higher than what? Inflation rate, generally. The second one is, when you look at, they also say there is low correlation between commodity returns and stocks and bond returns, suggesting that significant benefits of diversification. So which means when they talk about low correlation, they're basically saying your correlation coefficient between two assets can either be found between 0, +1, and -1. So this is where the correlation coefficient generally is found under. When your correlation coefficient is at +1, this is where we say the investments are positively correlated. So they are perfectly positively correlated, which means when you analyze the returns, we are saying when you analyze the returns between the return over time, so when you analyze the return over time, we are saying these assets, let's say, for example, you have two assets, asset M and asset N. We are saying if they are perfectly positively correlated, when one goes up, the other one is also expected to go up. So when this one experiences an upward movement, this one also is an upward movement. And when this one goes an downward movement, this one also is a downward movement. So if it's perfect, it means they're perfectly correlated. But sometimes it does not going to be necessarily have to be perfectly correlated. If the correlation coefficient between the assets is somewhere greater than 0 but less than 1, we just simply say they are positively correlated. So we just simply say the assets are positively correlated. Then, when your correlation coefficient is at -1, this is where we say the assets are perfectly negatively correlated. And in this case, we're saying when you look at the relationship of the returns of the two assets, when one is moving in this direction, the other one is moving in the opposite direction, which means when one is increasing, so when M is increasing, N is going to be decreasing. And then when M starts decreasing, N starts increasing. And when this one starts increasing, this one starts decreasing. So they're basically moving in opposite direction. If the movement is perfect, where the same units of upward movement is the same as the same units of downward movement, we say they are perfectly negatively correlated. But they're not always going to be exactly like that. If the correlation coefficient is between -1 and 0, we just simply say they are positively, sorry, they're negatively correlated. So we say the assets are simply negatively correlated. Then, when the correlation coefficient is at -1, so it's at 0, when the correlation coefficient is at 0, we just say there is no linear correlation. So there's no linear correlation because there's more of a random than any pattern that you can come up with as well. So it's more random than any pattern that you can come up with to say, is it generally going up or is it generally going down? So when it comes to our portfolio, our aim is to diversify our portfolio, where when we diversify our portfolio, we're ensuring that overall our returns should be netting off. When one is going up, the other one should be going down as well. So which means our aim is to have a correlation coefficient closest to -1. So our aim, if we are to diversify our portfolio, our aim is to have a correlation coefficient closest to -1. So which means when you are looking at commodities, when you look at the returns of commodities compared to the returns of equity of bonds, you see that their correlation coefficient is not necessarily +1. Their correlation coefficient is a lot less than 1. And because their correlation coefficient is a lot less than 1, it means that you are able to get some diversification benefits. So here, you are not diversifying your risk, because if things go south, your portfolio is also going to be negatively affected from your investment in N and also from your investment in M as well. So our aim is to try to find ourselves somewhere in between there, so that we are not looking to overexpose ourselves to risk in that case, by concentrating on portfolios or assets which are affected by the same variables. So when they talk about low correlation, it basically means that the correlation coefficient is lower than +1. And because they have a low correlation, what does that mean? It means we are going towards -1, where it means that there's also diversification benefits between commodities and investments in equity bonds as well. Are we on the same page? Any questions? Anyone lost?
Sorry, Reynolds, we are saying that we are looking for portfolios that are not affected by the same risk.
Economic variables or risk, yes, risk or economic variables, basically, or risk factors.
Thank you.
All right. Remember, as an example, a typical example of a commodity that people would consider investing in, let's say it's gold. And a typical example of an equity investment that one can consider investing in would be, say, shares in shares in BMW. What usually happens when the economy is doing well, we see that people are going to be buying a lot of cars. So they're going to be investing more of their money in BMW. But now, if the economy experiences a downward trend, what do we see happening? People are going to be looking to park their money in a store of value. And what is usually the ideal store of value? If you look at most central banks, although when we talk about America, it's a different case, although they say they have it, you will see that most central banks, their store of value that they store as a reserve value in case when things go wrong is gold. So the more gold a country has as a store of value, the better it is able to withstand. So you find that during periods of downward of economic recession, or periods of where the economy is in distress, people are going to be looking for a store of value, and you see that there's more investment in gold, which is a commodity. So do you see that the demand for these is going to be slightly different, where if the economy is doing well, they're going to be investing in equities mostly. But when the economy starts getting shaky, they're looking for a store in value. And what do? They start investing more in gold as well, which is a commodity. So because of this, the correlation coefficient between typical equities and typical commodities is usually very low. Hence, we say because of that, you are able to diversify your portfolio if you invest in both these type of investments. Are we on the same page? Any other questions? Moving on. If we move on to part B of the question, part B of the question, they give us that information. So they give us that information, and from the given information, they give us the allocation for Woodlands Group, and they give us the allocation for LETS pension plan. And at the same time, they give us the duration and the spread duration of these investments as well. So for part one of the calculation, they say calculate the duration of the bond portfolio and assess the interest rate risk of this portfolio versus the benchmark as well. So for part B, question 1, duration of the portfolio is given as the sum of the duration of the individual assets multiplied by the weights of the individual assets. So the duration of the portfolio is given as the sum of the duration of the individual assets multiplied by the weights of the individual assets in the portfolio. I still remember there was a bit of issues when it comes to this question. So here they say calculate, the question was supposed to be calculate the duration of LET expansion portfolio and assess the interest rate risk of the portfolio versus the benchmark. So we're looking at it for what? LET expansion plan portfolio. Now, when we look at LET expansion plan, what do we see? LETs, the duration is given as this, and the allocation is given as that as well. So which means in this case, you are going to say your duration multiplied by the given weights as well. So if that is the case, it would mean that the duration of the portfolio is going to be equal to, for the first asset in the portfolio is a duration of 7.54 and there's a weight of 10.1%, as a decimal is 0.101, plus the second asset is a duration of 9.02 and there's a weight of 14.5%, which is 0.145. The next asset is a duration of 4.52 and a weight of 20.9%, which is 0.209. Plus the next is a duration of 1.33 times the weight of 33.7%. So it's 0.337 plus the next asset is a duration of 2 and a weight of 0.082 plus the next asset is a duration of 3.22 and a weight of 12.6%, which is 0.126. So given this information, how much is going to be the duration of the portfolio?
I get 4.03.
So you get a figure of 4.03.
03.
Are we getting the same amounts?
Yes.
Okay. Any questions? Anyone lost? So on the question, it should indicate that the bond index has effective duration of 4.16. So that it should indicate that the bond index has an effective duration of 4.16. So duration basically measures interest rate risk. So the higher the duration, the higher the interest rate risk. So duration basically indicates interest rate risk. So the higher the duration, the higher the interest rate risk. So how is the interest rate risk of the bond portfolio compared to the index? How is the interest rate risk? Is it higher, is it lower, or is it the same of the bond portfolio compared to the index?
Is lower.
So in this case, we see that the duration of the bond portfolio is less than that of the index, isn't it? So it basically means that it is a lower interest rate risk. Than the index. So it is a lower, the bond portfolio has lower interest rate risk than the index. Are we on the same page? Next, they also ask us to calculate, so for part 2 of the question, they also ask us to calculate the spread duration, right? So in this case, they are asking us to calculate the spread duration. And remember, if you check on the calculation there, they are talking about Woodlands Grove bond portfolio. So they are asking us for the spread duration of Woodlands Grove bond portfolio, right? So for the second part of the question, the spread duration of the portfolio is the sum of the spread duration of the individual assets multiplied by the weight of those individual assets. So it's the spread duration of the individual assets multiplied by the weight of those individual assets. So if you sum them up together, you get the spread duration of the portfolio. So if you check on the question, we are told that when you look at Woodlands Grove, these are the weights, and this is the spread duration of Woodlands Grove as well. So we're given the spread durations and we're given the weights as well. So given this information, it would mean the spread duration of the portfolio will be given as for the first asset is a spread duration of 0 times the weight of 14.6% is 0.146 plus the second asset is 7.2 multiplied by 0.237 plus the next asset is a spread duration of 5.8 multiplied by 0.138 plus The next asset is a spread duration of 4.65 multiplied by the weight of 11.4%, which is 0.114, plus the next asset of the portfolio is a spread duration of 3.67 multiplied by the weight of 18%, which is 0.18, plus the next asset of the portfolio is a spread duration of 2.5 multiplied by the weight of 18.5%, which is 0.185. So given this information, how much would be the spread duration of the portfolio?
I get 4.6.
4.60.
4.16.
Okay, so we get an amount of 4.16. Are we all getting the same amount?
Yes.
Okay. Any questions? Anyone lost? So on the question, they say, how is the spread duration of this portfolio compared to versus the Singapore mortgages? And if you check under Singapore mortgages there, you will see that the spread duration is 4.65 in this case. So for Singapore mortgages, the spread duration is 4.65. So for Singapore mortgages, so how is the spread duration of this portfolio compared to Singapore mortgages? Is it higher? Is it lower? What is it?
Lower.
So in this case, our spread duration is lower than 4.65. So if our spread duration is lower than 4.65, it means spread duration measures credit risk. So spread duration measures credit risk in the sense that when you look at the spread, your spread is basically, so your spread is the difference between the interest rate on corporate bonds or on a corporate bond minus the interest rate on a government bond. Like for example, if it's going to be treasury securities or treasury securities. So that is the spread. So the spread is basically the difference between the interest rate between the corporate bonds and the interest rate in government bonds. So which means in this case, during periods of economic distress, you expect, remember, your interest rate as a formula is given as, so your interest rate as a formula is given as, so remember we say your interest rate is given as the risk-free, the real rate of interest plus inflation premium plus risk premium. So this will give us the nominal interest rate, and this makes up our risk-free rate of return. So what do we see? Government securities, generally, they are considered to be risk-free, but corporate bonds, they need to take into account risk premium. So in this case, the corporate bonds, they need to take into account the risk premium. So what does that mean? During periods of economic distress, corporate bonds are going to be having a higher risk premium because there's more risk that they might end up failing to meet their obligations. Because when it comes to corporate securities, remember, they are, when the economy goes through economic distress, there's a higher chance that they might end up failing to meet their interest obligation, or there's a higher chance that they're going to end up failing to meet what? Their repayment, principal repayment obligations as well. But when it comes to government securities, they can either raise the interest rates, as we saw that when the new president came in, one of the first things that he did was increasing the value-added tax, right? So that they're able to raise money to cover the loopholes. Or they can either raise taxes or they can just simply print money so that they're able to meet their obligation. Hence, we say the interest on government securities is basically considered to be risk-free. So because of this, what do we see? When the economy goes through a downward trend, we see that this difference in interest rates goes up. And when the economy goes through an upward trend, the difference in interest rates goes down because what? There's less risk to corporate because generally they're expected to do well when the economy is what? Is doing well at the same time. So what does that mean? So it basically means this spread duration, or the spread of the difference between the interest rate on the corporate bonds and government bonds, in a way, it's also indicating how much credit risk is there. Because remember, this risk premium is being explained by the credit risk, effectively, when you look at it in this way. So which means, what it means is that, so if the spread shows credit risk, then the spread duration should be linked to the risk over a given time period in your portfolio as well. So the higher the duration, the higher the credit risk of a particular portfolio. So the higher the duration, the higher the credit risk of the portfolio. So what do we see? Our spread duration of the portfolio is 4.16, and the spread duration of the Singapore mortgages is 4.65. So what does that mean? It means our portfolio has lower credit risk than the Singapore mortgages. So our portfolio is lower credit risk than the Singapore mortgages. Are we on the same page? So ideally, that's how you would answer part 2 of the question. Any questions? Anyone lost? All right. So can you take a few minutes break until 3:35? So can you take a few minutes break until 3:35? Then at 3:35 we continue with that with the assignment. So can you take a few minutes break until 3:35, and then at 3:35 we continue with the assignment. All right, can we continue? So we're now continuing with part B. So we're continuing with part B, but we're now on question 3. So we're now on part 3 of question B. So we're now on part 3 of question B. And look at part 3 of question B. They give us that information. So they give us that information and they say, compute the Sharpe, Trainer, and Jensen measures of each portfolio. So they ask us to calculate the Sharpe, Trainer, and Jensen measures of each portfolio. So for the Sharpe Performance Index, your Sharpe Performance Index is given as, so your Sharpe ratio is given as the return of the portfolio minus the risk rate of return divided by the standard deviation of the portfolio. So that's how we are able to determine the Sharpe ratio. Then from there, they also ask us to calculate the trainer. So your trainer ratio is given as the return of the portfolio minus the risk rate of return divided by the beta of the portfolio. So that's your trainer ratio. Then the next one is the Jensen measure. And when it comes to the Jensen measure is given as, so the Jensen measure is given as the return of the portfolio minus the capital asset pricing model. And on the capital asset pricing model, it will be the risk rate of return plus beta, the market return minus risk-free rate of return. And remember, when you look at this, your market return minus risk rate of return, they also refer to it as the market risk premium. So they also refer to it as the market risk premium. So from the given information, when it comes to the Sharpe ratio of the portfolio, if you check on the portfolio, the different portfolios that are invested in, they gave us the, from the different portfolios that they give us there, from the different portfolios, they give us portfolios A, B, and C. And on these portfolios, they tell us, they give us the returns, they give us the beta, and they give us the variance. Do you see that they're giving us the variance, not the standard deviation? But we know the square root of the variance gives you the standard deviation. So the square root of the variance gives you the standard deviation. And then they also say the SSE index represents the market portfolio, which is the return on the market. So the return on the market in this case is 24%. Then they also say the risk-free rate of return in this case is 7%. So for portfolio A, the return of portfolio A is 42%. The risk-free rate is 7%, right? So the return of the portfolio is 42%, and the risk-free rate is 7%. And for the Sharpe ratio, we're given the variance. And for the trainer ratio, we're given the beta in that case. So to do the calculation, it would mean we're going to say, so to do the calculation, it would mean we say the Sharpe ratio of portfolio A is equal to the return of the portfolio is a decimal of 0.42 minus the risk-free rate as a decimal. Remember, they say the risk-free rate is 7%, which is 0.0, 7. So they're giving us these figures for the variance. Is it 2.2 or is it 2.2% or what? All right. If you check on the question, for portfolio A, they just give us the variance being 2.25. So they're giving us the variance being 2.25. If you check on the lecturer's memo, they're giving us 1.5.
So what I saw, Rhinos, is that I think that the lecture did the square root of
2.25.
0.0225 and then multiplied by 100, because the square root of 0.0225 is 0.15.
Yeah, just give me a second. 1.21 square root of that is 1.1. Okay, that's weird. So this, okay, that's weird. The returns are given as percentages. The risk-free rate is a percentage. The variance should be a percentage as well. So why are these ones given as decimals and this one here taken or treated as a full percentage? Okay, I'm not sure what was happening here, because usually if they give you the variance, I don't know whether the variance is okay. So if they give you the variance, okay, what the lecturer did here, is that, remember the variance was given as 2.25. So we know that the standard deviation is given as the square root of the variance. So the standard deviation is given as the square root of the variance, which means in this case, it's going to be the square root of 2.25. They're using the variance as a full percentage for some reason. I'm not sure why, but they are using the variance as a full percentage. But the return of the portfolio and the risk-free rate, they are using them as decimals. Because usually, when you look at the Sharpe ratio, it's a percentage. It's a percentage. Standard deviation is also a percentage as well, unless they're telling us that the standard deviation is given in rand or another notation. Okay, so they're giving us the standard deviation, and then they are using that figure exactly as is. Why they are doing that, I'm not sure, unless they are using the reasoning to say your standard deviation is given in rand. So if your standard deviation is given in rand, you take it as is as well, which means that if the variance is given in rand, you're just going to say the square root of the variance would give you the standard deviation in rand as well. Yeah. So this is how you would get the Sharpe ratio according to the lecturer. On your scripts, did the lecturer mark you wrong if you had put in it as decimals? If you put it as decimals, did the lecturer mark you wrong?
It didn't mark at all.
Mine was not mapped.
Yeah, because I'm not sure when it comes to this variance, are they saying that this variance is in rand, or are they saying that this variance is in percentages? Because remember, it's always going to be one of the two. It's either the variance is given in rand or the variance is given as a percentage. So now the question would be, are they saying that this variance that is given as 2.25, is it in rand or is it in percentages? But somehow, when you're calculating the Sharpe ratio here, the lecturer just said the square root of 2.25. I'm not sure exactly why he used that reasoning. Because the question would be, is it just a figure, which is not usually the case? The variance is basically a measure of risk, which means that in that case, it's either you're going to put the variance in rand or you're going to put the variance in percentages. It's always going to be one of the two things. So unless they say this variance of 2.25 was in rand, then if it was in rand, because remember, your risk is not only measured in percentages, you can also measure your risk in rand as well, in a currency. So if they are saying that the risk in this case is in rand, then it means that it's going to be the square root of 2.25 because we take it as is. So if you do that calculation, how much would be your Sharpe ratio? Mm.
0.23.
0.23. Okay.
Yes.
Then your Sharpe ratio for portfolio B, are we all getting 0.23 before we move on?
Yes.
All right. Now, when you move on to portfolio B, you see that for portfolio B, your portfolio return is 25%. Remember, your risk-free rate is 7%, and they give us that the variance is equal to 1.21. So if your variance is 1.21, and given that information as well, it would mean your Sharpe ratio is going to be your return of the portfolio, which is 25%, so it's 0.25 as a decimal. The risk rate is 0.07 divided by the square root of your variance, which is given as 1.21. So given this information, how much would be your Sharpe ratio for portfolio B?
0.16.
0.16. Are we all getting the same amounts? Next, we also look at portfolio C. And for portfolio C, they gave us that information and they say the return is 16%. Remember, your risk-free rate is 7%. And then they tell us that the variance is 2.25. So if your variance is 2.25 and also given that information as well, it would mean your Sharpe ratio for portfolio C would be your return of 16%, which is 0.16, minus your risk-free rate of 0.07 divided by the square root of your variance, and your variance in this case is 2.25. So given this information, how much is going to be the Sharpe ratio for your portfolio?
0.06.
0.06. Are we getting the same amount? Next, we need to calculate the trainer ratio for these portfolios as well. And if you check all the information that we're given, remember everything else is still the same on the numerator. The difference now comes in with the denominator, where for portfolio A, your beta is 1.2. For B, your beta is 1.8. And for C, your beta is 2.2. But on the numerator, everything else is going to be the same as what we did previously. So which means in this case, your trainer for portfolio A, the numerator is going to be the same, 0.42 minus 0.07, but your beta now is 1.2. So given this information, how much is your trainer ratio?
$0.29.
Okay. Are we all getting the same amount?
Yes.
All right. Then for the trainer for B, so your trainer ratio for B would be 0.25 minus 0.07 divided by, for B, your beta is 1.8. So how much would be the trainer ratio for portfolio B?
0.1.
0.1. And your trainer ratio for C is equal to 0.16 minus 0.07 divided by the beta of 2.2. And how much do we get as the trainer ratio for C?
0.04.
0.04. Are we on the same page so far? Any questions? Now we need to calculate the Jensen measure for A. And your Jensen measure is the return of the portfolio minus that information there. Now, if you check on the information that we're given, remember they say on the question, the SSE index represents the market portfolio. So the return on the index in this case is the market return. So the return on the index in this case is the market return. So which means when you now look at portfolio A, it would mean that for portfolio A, you're going to say the return of the portfolio A is 42%, which is 0.42, minus your risk-free rate is 7%, which is 0.07, plus your beta for portfolio A was given as 1.2. And we see that the market return is 24%, and your risk-free rate is 0.07. So given this information, how much do you get as the Jensen measure for portfolio A?
I get 0.146 or 0.15.
Okay, to 2 decimal places, you're getting 0.15. Okay,
Yes.
so it's 0.146. Okay, which is okay. And your Jensen for portfolio B would be for portfolio B. Remember, we're given that for portfolio B, the return of portfolio B is 25%. So it's going to be 0.25 minus the risk-free rate is 0.07 plus your beta, which is 1.8. Market return is 0.24 and your risk-free rate is 0.07. So given this information, what is your Jensen measure for portfolio B?
Get negative 0.126 or negative 0.13.
Negative 0.13. And then your Jensen measure for portfolio C would be, for portfolio C, your return of the portfolio is 0.16 minus your risk-free rate is 0.07 and your beta for portfolio C is 2.2 multiplied by 0.24 minus 0.07. So given this information, how much do you get as your Jensen measure for portfolio C?
Minus 0.28.
Minus 0.28. Are we all getting the same amounts? So remember, part 3 of B, they were just asking us to compute the Sharp trainer and Jensen measures for each portfolio, which is what we have done. Then for part 4 of the question, they say, identify which portfolio had the best risk-adjusted performance in 2021 and justify your selection with 2 supporting arguments. So if you check on the portfolios, if you look at the Sharp ratio, portfolio A is 0.23, 0.16, and 0.06. So which one was the best performing in this case? When you look at the Sharp ratio, the trainer ratio, and the Jensen measure, you are looking at performance, portfolio performance. So the higher the ratio, the better the performance of the security. So the higher the ratio, the better the performance of the given portfolio. So from the given portfolios, if you look at the Sharp ratio, which one was best performing?
A.
So here, A was best performing. And when you look at the trainer ratio,
A.
so A was also best performing. And the Jensen measure, it's clear because these ones are having negative risk-adjusted returns. So this A was also best performing. So When you look at the Sharpe ratio, trainer ratio, and the Jensen measure, A was best performing, and over and above that as well, from a total risk perspective, would also support that. From a total risk perspective, we'll see that A was still the best performing portfolio. So there's no issues regarding which one was better there, because in all instances, portfolio A was having the highest risk-adjusted return. So if you check on the lecturer's memo, it says portfolio A has the best risk-adjusted return. So portfolio A had the best risk-adjusted return. And when it comes to the supporting arguments, the same. Portfolio A had the highest excess return relative to total risk measured by the portfolio standard deviation. So for every unit of standard deviation, A's return was higher. As seen by the trainer measure, portfolio A therefore had the highest return relative to systematic risk. So portfolio A also had the highest Jensen measure, exceeding its expected return as calculated by the capital asset price model by a much higher figure than B and portfolio C that failed to achieve its expected return as calculated by the capital asset price model. So when you look at these arguments, when you look at the Sharpe ratio, we're saying how much is the excess return over and above the risk-free rate per unit of standard deviation. So how much is the excess return per unit of standard deviation? So this is basically the same as saying 0.23 over 1, because you're saying how much is the excess return per unit of standard deviation. So this is the same as saying 0.16 over 1, and this is the same as saying 0.06 over 1. So for per unit of total risk, remember we said your total risk is given as systematic risk plus unsystematic risk. So it's your systematic risk plus your unsystematic risk. Then from there, you will say the systematic risk is also referred to as the non-diversifiable risk. And your systematic risk is also referred to as your diversifiable risk. And then we also see that your total risk is measured by the standard deviation. And your systematic risk is measured by the beta. So when you take into account total risk of the portfolio, you are saying how much excess return is each portfolio generating for 1 unit of total risk. So how much excess return is each portfolio generating for 1 unit of total risk? And as you can see, portfolio A is best performing. Then here, when you look at the trainer measure, you're basically saying how much excess return, is each portfolio performing for 1 unit of systematic risk, which is your beta. So given that your beta is equals to 1, so for 1 unit of your systematic risk, how much is each portfolio performing? And we see that with the trainer measure, A is still better performing. Please take note, whenever there is a conflict between your assessment using the standard deviation and your assessment using the trainer, the standard deviation is more superior. So whenever there's a conflict of assessment between the standard deviation and any one of these, the standard deviation is more superior. The reason why we say the standard deviation is more superior is mainly because, remember, the standard deviation measures total risk, but your trainer measures only takes into account systematic risk, and your Jensen measure only takes into account systematic risk as well, which means these two, they assume portfolio is diversified. So they assume that the portfolio is diversified, which is not always the case. So because they assume that the portfolio is diversified, you see that it's not always going to be the case that the portfolio is fully diversified, because if the portfolio is fully diversified, your diversifiable risk falls away, and the only measure of risk you're going to worry about is the beta. But it's not all the time that the portfolio risk is always going to be fully diversified. And because of that, this is where these two basically falls short when they are competing with the Sharpe ratio. Now, when you look at the Jensen measure, you are basically looking at your return of the portfolio against the expected return. So you're comparing the return of the portfolio against the expected return. And remember, we say when the return of the portfolio is greater than the expected return, we say the security is undervalued. And when a security is undervalued, it means you should buy. It's a good investment. So what do we see? For A, the return of the portfolio is greater than this, hence we're positive amount. But for B and C, the return of the portfolio is less than this. If it's less than that, what does that mean? It means the portfolio is what? Is the opposite. It's overvalued. And when something is overvalued, what does that mean? You sell. Are we on the same page? So these are some of the things that if the lecturer tries to make this calculation a bit more difficult, or this question a bit more difficult, you might have a situation where there is a conflict of ranking between these different measures of performance. So whenever there's a conflict of ranking between these different measures of performance, check to see when we are using these ones, are we saying these portfolios are fully diversified? If they are not fully diversified, then these measures are no longer relevant. They are no longer relevant because they always assume that your portfolio is fully diversified. That's when they are reliable. The moment a portfolio is not diversified, they are not going to be reliable measures of performance. Then the Sharpe ratio, this would make the Sharpe ratio more superior because the Sharpe ratio takes into account all the risk, which is the total risk, as measured by the standard deviation. Are we on the same page? So the reason why I'm emphasizing this is mainly because my suspicion is to justify what has been happening over the year. I have a suspicion that the lecturer is going to bring some of the questions based on concepts that were in the assignment. so that if you understand the concepts in the assignment, you should be able to answer those questions and generate more marks for yourself. So that, because remember, at the end of the day, if many students fail, the lecturer looks bad. So my suspicion is, if the lecturer says, look at the assignments and look at the new material in the textbook, in the new textbook as well, it means that there is a strong suspicion that there are some questions that were in the assignment that the lecturer is likely to shuffle. Like when I say shuffle, I mean he's likely to change them a little bit, then bring them again. Then from there, bring in questions from the new textbook as well. How he's gonna bring the new questions, no one really knows, because at least if he had given student practice questions, we'll be having an idea of exactly. So in the new textbook, are we going to be concentrating more on analysis, or are we concentrating more on calculation as well? It's very difficult to judge at this point in time. Because as you can see, the practice questions so far that were in the new textbook, they are mostly based on analysis than the calculations themselves. The examples in the textbook, that's where you see calculations. But when it comes to the practice questions, it's more of analysis than the calculations themselves. So that's why there's a bit of, struggling to understand exactly how the lecturer is going to bring in such questions in the exam, if it's going to be based on the new textbook as well. But so far, are we on the same page when it comes to what we've covered so far in analyzing? Remember, we're not just concentrating on answering the questions in the assignment. I try to explain this concept a little bit further so that if the lecturer shuffles these questions and bring in new information which changes the analysis as well. Because remember, this was a very easy analysis, because either way, portfolio A was superior, but it's not always going to be the case. If you look at past assignment questions as well, there were questions where there was a conflict between the Sharpe ratio and these other measures as well, where one was superior with the Sharpe ratio, and then with the Trainer ratio and the Jensen ratio as well, there was one which was more superior than the one that you would have seen that is superior with the Sharpe ratio as well. And that's why there was a bit of conflict. So there, please take note of these concepts. I'm emphasizing this because I'm suspecting that there is a high chance that if the lecturer says, look at the questions in the assignment, and that there's a chance that he might shuffle those questions in the assignment and make them and bring them again in the exam, so that at least if you understand what was being asked in the assignment, you should be able to get those answers in the exam as well, so that at least students are not going to be thrown off that much as well. Because remember, as we stand right now, no one really knows what's going to happen in the exam, mainly because the only thing that we received was, as an idea of questions, was assignments, of which the assignments were mostly based on the previous textbook, to be honest, than what? The new textbook. There is nothing that they brought in the assignment that I would say is unique to the new textbook. So if they say that the exam is going to be based on the new textbook, that's where it's a bit tricky there. But remember what I'm saying, there is a chance that the questions that were brought in the assignment, the lecturer might bring those questions again in the exam, but just trying to change them a little bit as well. Then from there, maybe pick a couple of questions as well from the new textbook so that it balances it off as well. That's my suspicion, but the way things are looking, it's very difficult to judge because there was not that much information coming from the lecturer during the year anyways. So are we at least on the same page when it comes to this particular question? Any questions? Any need for further explanation? All right, it was quite a lot of information to consume. So please go back and review these assignments. So it was quite a lot of information for you to consume. So please go back and review these assignments, because my suspicion is there is likely to be questions coming based on the questions that have been brought in the assignment, where the lecturer is going to bring in the same concept that was asked in the assignment, but he's just going to change the information so that the analysis is going to be slightly different from the previous one as well. There's a high chance that the lecturer is going to do that. Then bring in questions in the based on the new textbook as well. So please, my homework to you is, please can you go back and review assignment 1 and assignment 2. If you are struggling with anything from assignment 1 and assignment 2, please let me know so that I'm able to explain those concepts a little bit further as well. Then in the next class, we finish practice question 3. Remember, there was one question from practice question 3 that was quite a long question that needs to be done, where there's a lot of calculation that needs to be done as well. And I don't think we'll have enough time to finish it all at once today. So rather start it on a new page. Today, make sure that you review everything. So please make sure that you review assignment 1 and make sure that you review assignment 2. Understand the concepts from assignment 1 and assignment 2, because I have a strong suspicion that the questions from assignment 1 and assignment 2, the lecturer is likely to bring those questions, but he's just going to match them up so that is what so that the analysis is going to be slightly different, but the calculation and everything might be very much related as well. So please take note of this, especially remember when it comes to these performance index or performance measures as well, they were in the new textbook. So they are in the new textbook, these performance measures. They are still there. They were in the old textbook and they are in the new textbook as well. So I have a strong suspicion that these performance measures, there might be a question that might be asked as well, because remember, these ones, they were in the old textbook and they are basically in the new textbook. Although in the new textbook, they are concentrating more on analysis than the calculations themselves as well, in understanding how they are linked with each other as well. So as your homework, please review assignment 1 and assignment 2. Then in the next class, I would have sent you the practice question 4, which is the next practice question, set of questions. And at the same time, we're going to be finishing practice question 3, because there's another question from practice question 3 where the concepts there, they were in the previous textbook and they are now brought into the new textbook. But the way those concepts are brought in the new textbook is no longer just about calculations. The way they are brought in the new textbook is more about analysis of the question and making recommendation based on your analysis as well. So you see that the new textbook is very much different from the previous textbook, where in the previous textbook there was calculations and understanding, but now in the new textbook they are concentrating more on understanding the concept than just calculation, where in understanding the concept, there are basically different things that you need to put together so that you're able to make a recommendation as well. Because remember, it's, in the new textbook, they're concentrating more analysis and recommendations for your for portfolio management as well. And because of this is why you find that when it comes to the new textbook, it's a bit more in depth, it's a bit more demanding. Reason being, it's not just calculations and small analysis. It's calculation, but they are concentrating a lot more in analyzing and making recommendation when it comes to the different case studies that they give in the analysis. And the other thing that you need to take note of is that when it comes to the new textbook as well, the practice question that they're giving out, it's mostly case study type of questions. So I'm not sure exactly how the lecturer is going to balance it out to say, is he going to be bringing a lot more case studies when it comes to the exam, or is it just going to be those short questions like what we've been seeing previously, where it's just a short question where you just do a calculation in a small analysis? Because remember, the moment it becomes a case study, it's more of analysis and recommendation than the calculation part as well. So please make sure that you review assignment 1 and assignment 2. If you are getting stuck, please let me know as well, so that I'm able to explain a little bit further when it comes to that. Then in the next class, we continue with the practice questions. Are there any questions? All right, if there are no questions, enjoy the rest of your weekend.
Thank you. Bye, Rhinos.
Thank you. Bye.